Hello, and this is a little instruction video on Learning Plan 2 that deals with the Form 4562. So if we go into Blackboard and go into our Learning Plan 2, it shows us that this is due next Friday, September 16th, so we have a little while. Learning Plan 2, the Form 4562, deals with the depreciation and amortization for assets that are capitalized. If we look in the reading and handouts, we can see that the actual instruction booklet for the form is optional to read because it's quite a few pages. But what I do want you to read is Chapter 7 in the publication 225, which is the Farmer's Tax Guide. This is a big publication. There's a lot of reference to various items, but Chapter 7 in particular is for the depreciation. So what we're going to go over is a couple items for the actual depreciation. So I'm going to open the Farmer's Tax Guide so we can go through a couple of things, and we are then going to go to Chapter 7 once it opens. Depreciation is for expensing assets that have to be capitalized. When you purchase big pieces of equipment, build buildings, certain livestock, that type of thing, they can't just be written off as an expense. They have to be capitalized and depreciated over their useful life. So this is what we're doing in this learning plan, determining those deductions for each year of the useful life. When it opens, the first thing that we are going to go over is what can be depreciated. And there are a couple different rules for that. If we look in this section right here, it says that we need to own the property. We can't have it be rented or leased. It has to be used in business or in income producing activity, so it can't just be an inactive asset that is sitting around. It has to have a determinable useful life, and that useful life has to be substantially extended beyond the year that is placed in service. A couple of things that cannot be depreciated is inventory and land. Land never gets depreciated because it really doesn't lose its value. And inventory that is held for use in the business is not depreciable because it's used in the ordinary course of the business. Another item to note is that an asset that is bought and sold in the same year is not allowed to be depreciated either. So that just gets handled a little bit differently. That is not the case in any of our case studies, but it's just a good thing to remember. A rule for livestock. So livestock that's going to be held in inventory cannot be depreciated because inventory is not depreciable. But livestock that is purchased and used for drafting, breeding, or for dairy can be depreciated. And that is over the course of however many years the useful life is. So in order to determine when depreciation begins and ends, we have to look at not necessarily when the asset is purchased, but when the asset is placed in service. So the asset can be purchased, say, in January, but not placed in service until June. And we have to start the depreciation in June rather than January because we did not use it until June. So there is two different what they call conventions for determining how, and I'm scrolling down just a little bit here, but two different conventions for determining how to calculate the depreciation. The main one that we're going to be concerned with is called the half-year convention. This is the normal convention that's used for the most part. However, another one that you will have one of the case studies to deal with is called the mid-quarter convention. This means that there are special depreciation percentages that are used. So a mid-quarter convention means that more than 40% of the total assets that were bought in the year were bought in the last 3 months of the year. So if 40% or more of the assets were bought in October, November, and December, then you have to use this mid-quarter convention, and the mid-quarter convention uses smaller depreciation percentages because the objective is to avoid having people purchase things all at year-end. If we look on our depreciation tables, which are in the reading and handouts, we will be able to see that there are different percentages for the half year and the mid-quarter. The half year is a little bit more accelerated in certain times over the mid-quarter. The next thing that you have to determine is the useful life of the asset. This is not some random number that can just be picked based on what the taxpayer think. There's guidelines for what different types of equipment or buildings have for useful lives. This table 7.1 right here on page 43 of the publication 225 is going to show you the farm property recovery periods or useful lives. So this is what we would be going off of, this GDS column right here. Farm assets are somewhat special in that they're allowed a different depreciation method. Usually the depreciation method used is called 200 declining balance, but farm assets are allowed to use 150 declining balance, and that just gives them a little bit more of an advantage that way. And only farm assets are allowed to use this 150 declining balance method. Other businesses are not. So in all of the case studies, if we open one of them up, in all of the case studies, I'm going to tell you what the useful life is, when they were placed in service, what amount, therefore you're not going to have to figure any of that out. So if we look at the first case study for the practice, I'll tell you that the farm machine, in parentheses here, has a useful life of 7 years and was placed in service in September of 2016. So you don't have to determine anything like that. And I'll also tell you, as in this first one, that for this you should be using the mid-quarter convention. So you aren't going to have to determine that at all. Two other things to note for depreciation is that there are two kinds of special depreciation. One of them is called Section 179. And this means that you are allowed to take all of the cost of the asset, or a portion if you choose to only take a portion, as a deduction in the year that is purchased. So if you bought an asset for $15,000 and elected to take Section 179 on it, instead of determining the depreciation percentage and then taking the $15,000 times that percentage, you actually get to take the whole $15,000 as the deduction. The good part of this is that you have a large write-off in that year. The bad part is that you don't have any more depreciation in the coming years to offset any additional income you might have. So another option in a different depreciation method is called bonus depreciation. This is not something that is allowed every year, but for the last couple of years has been reinstated by the IRS each year in order to be allowed. The bonus depreciation for the last couple of years is 50% is allowed of the asset is allowed to be deducted right away, and then the remaining 50% is depreciated based on the useful life and the depreciation percentage. So if we had an asset for $12,000 and elected to take bonus depreciation on it, that first $6,000 is automatically a depreciation expense, and then the remaining $6,000 gets multiplied by the depreciation percentage for that year. So this helps to take a larger deduction for depreciation, but it also helps to spread out and still have some depreciation in the next or in the coming years, so that's not used all in one year. So then if we actually look at the Form 4562 and look at all of the different sections, we can see that each section shows a different type of depreciation. Once this opens up, so we can see in part 1, or this first section, this is all for property that is being taken Section 179. So this is all of the assets that are going to be expensed right away. So we can see that we have to do a description of the property, the total cost, and then the elected cost. Normally the elected cost is going to equal the total cost, but it doesn't necessarily have to. So the amounts get totaled here, and then we have to look to see if it needs to be reduced at all. The only reason it would be reduced is if there were a lot of assets purchased in the year. And the reason for that is because there are limits for how much Section 179 can be taken in a year. The amount that is the highest amount of the limit is $500,000. So this is the most that you can write off, with the $2 million of asset cost being the max. If you start to go over the $2 million in assets purchased, you have to reduce that $500,000 that you're allowed to take dollar for dollar. So once you get up to $2,500,000, you can't take Section 179 anymore. It's just not allowed. There are very, very, very few instances where this is ever going to be an issue, so that is not something that you really have to worry about. The next part of the Form 4562 is for the other special depreciation, the bonus depreciation, and for other depreciation. So this other depreciation, what that's mainly going to include is different forms of depreciation. So if you were electing to take an asset via the straight line method of depreciation rather than the double declining balance, this is where that part would go. We don't have anything like that either, so we don't have to worry about that. Section 3 is going to be your new assets that you're purchasing in the year. So they have it broken down between the year, the useful life of the property. So if you have 3 different assets that are considered 5-year property, all 3 of those assets would be totaled and put on this line. So on here we would do the basis or the cost. then the recovery period is going to be 5 years. The convention we know is either going to be half year or mid-quarter. The method is going to be our 150 declining balance, and then column G here is going to be what our deduction is. Another item to note in this part is that this line 17 right here is for the assets that you're still taking depreciation on but have not been purchased in the 2015 year or in the current year. So if there was a 5-year asset that was purchased in 2013, the amount of that depreciation is going to be labeled or listed right here instead of down here because it's an older asset. Section 4 is the summary, so it's going to total everything that you're calculating in the other sections. If we go to the next page, this shows our listed property. The listed property that you're going to be concerned with is automobiles and trucks for the most part. These are broken down into 2 different sections. The ones that are used more than 50% in the business and ones that are used less than 50% in the business. So you have to determine the business percentage for these types of assets, and if it's anything less than 100% business use, that is what you are depreciating. So if it's only 75% business use, you're only going to depreciate 75% of the cost of that truck or that car. There are rules that say that you have to keep good records, that type of thing. Is there written statements or written documents showing if you have this all for business use? That is what the remainder of this section is, and we again are not concerned with that for this time. The last part on the Form 4562 is for amortization. So this is for assets that are amortized rather than depreciated. A couple different assets would be intangible assets, goodwill, client lists, that type of thing, which neither of those you're really going to run into at the farm. But another thing that you may would be software. So if you buy a software and it is only has a useful life of 3 years, it gets amortized rather than depreciated and then gets stuck down in this section. So that's a really quick overview of the Form 4562 of the assets that are depreciated. So read the publication 225, that chapter 7. Just skim over the instruction booklet for the 4562. It has a lot of information in it and it goes pretty in depth, but just look over the basic part of that. Take a glance at the depreciation tables just to kind of familiarize yourself with the things. See where you're going to go to get certain percentages, how you figure that out. There's going to be another video that I post on here that is going to do some examples, so that way you can go to your case studies and have some familiarity with the calculating the depreciation and then entering it on the Form 4562. But if you have any questions on anything, either give me a call or send me an email, and then we can discuss things that way, or if you have any specific concerns with the case studies. Otherwise, check out the demo videos and then do the case studies and the learning plan, or the quiz in the learning plan.